Hi everyone, Lee Pacchia from Mimesis Law here. We're talking to John Wilson today. He's a partner at Foley Lardner, and we're talking about proxy season. Welcome, thanks for joining us.
Thanks, Lee.
I want to drill down and get your thoughts on this rise of shareholder activism that we're seeing. What are some of the top-line consequences for this trend?
Probably the biggest consequence is that no one is longer safe. Everyone needs to be thinking about activism. It used to be more smaller companies where activists could take a sizable position in them and make a difference as a result of those stock holdings. Now you see large cap brand name companies, Apple, Microsoft, et cetera, where activist shareholders come in and still a large investment, but a relatively small proportion, a few percent of the stock, and make noise. As you look at your board composition, if you have a lot of long tenured directors, you want to think about refreshing the board, whether it be because of tenure or diversity reasons, to keep bringing in new directors with new ideas. Want to continually look at the company's position from a strategy perspective, from a capital allocation perspective. Are we doing the right things with the shareholder money to try to avoid being an activist target?
It's really interesting to take a look at the shareholder activism rise that we've seen recently, because when you break it out from a historical perspective, it seems like a dramatic uptick. It seems like something is really different and has changed this time around. Is that right? And in your view, what has changed?
That is absolutely correct. In 2014 here, we've seen over 350 activist campaigns at public companies, and activist funds that are in that class currently have over $100 billion under management. The larger activist funds are going after some of the more large cap companies, but you see a lot of smaller funds going after smaller cap companies. I think it's also been a combination of companies have less takeover defenses today that makes activist attacks easier, in part to investors over the years trying to eliminate things such as staggered boards at companies and the like, and with the elimination of that, it makes it easier as a mechanical matter to run a proxy contest and be successful. Just to throw a statistic out there, during this past year, over 70% of activist situations, they've been successful either in getting a settlement where directors go on the board or some other agreed to action, or successful by ultimately taking it to a shareholder vote. And so you see that level of success and these funds being able to raise a lot of money. People want to get into that because it's a way to make money. At some point we may see a scenario where some of the companies where the activists have come in, that there haven't been good shareholder returns of it, more of that than not, that may lead to a decline in this, but at least for the foreseeable future, we would expect activism to continue to grow.
Complicating things, we're seeing a nice uptick in M&A activity this year, which I guess a lot of lawyers are happy to see. Where do you see this trend heading, and what does 2015 look like in terms of deal flow? Are we going to see more deals next year than we did this year?
I think the answer to that is yes. Certainly 2014 has been a great year here as far as M&A goes, both globally and U.S. deal flow is back up to the record types of levels that it was at pre-recession. And from everything I've seen, I think people expect that to continue into 2015. There's recently been a couple surveys out there of what executives are expecting, and most of them see it as continuing to be a good deal market next year. Interest rates are still relatively low. A lot of financing flexibility that way. Valuations are relatively high, so companies that maybe perhaps in the past wouldn't have wanted to be on the sell side now are looking to sell. Other companies, in part due to shareholder activism, are looking to streamline the businesses that they have and just focus on the most strategic businesses they have, and therefore divest other businesses. Private equity continues to raise a lot of money to buy companies, as well as because for a number of years while the recession was going on, they weren't selling as many companies. Those companies that have been in their portfolios, they're looking to sell. So across the board, there's a lot of reasons to see M&A continue to increase next year. One never knows if there's a shock to the economy and all of a sudden there's a downturn. That can change very quickly, as we've seen it happen in the past, but at least the way things look now, we would expect more M&A next year.
Good stuff. John, thank you for stopping by and talking to us.
Thanks, Lee. That's
John Wilson, partner at Foley & Lardner. If you'd like to see more of the stuff they're working on, be sure to go check them out at Foley.com. You can also find them on LinkedIn, YouTube, and Twitter. I'm Lee Pacchia. Thanks for watching.